All right, let's talk about what happened in the markets today. Friday, February 13th, 2026. It was a pretty rough day for Asian markets, especially in the tech sector. So in this explainer, what we're going to do is dig deep, get past the simple headlines, and really figure out why things dropped. And, maybe more importantly, we're going to lay out a clear data-backed game plan for what could come next.
So here's how we're going to break it all down. We'll kick things off with the hard numbers, then get into the reasons behind the decline. We'll explore the psychology driving investors, zoom in on what's happening in China and Hong Kong, give you a forecast for the rest of February, and then wrap it all up with a solid, risk-managed quant strategy. Let's get right into it.
Okay, first things first. Let's ground ourselves in the data and just look at the raw numbers from today's close.
Okay, so take a look at these numbers. What's really jumping out at you here is the contrast, right? You've got the KOSPI, the big broad index which, well, it dipped, but only by a pretty modest 0.28%. But then you look over at the KOSDAQ, which is packed with tech companies, and wow, it took a much bigger hit, down 1.77%. That difference right there, that's our first big clue. It tells you this wasn't just a bad day for everyone, it was a really bad day for high-growth tech.
So, that's the what. Now let's get into the why. And trust me, this was not some random out-of-the-blue drop. It was more like a perfect storm of different factors all hitting at once. Everything from folks getting a little tired of the AI hype to big shifts in what central banks are doing around the world.
You can really think of today's decline as being caused by these four main drivers. First, there's a real sense that the massive spending on AI infrastructure is starting to slow down, and that's making investors nervous. Then, on top of that, you've got the US Fed sending some pretty aggressive or hawkish signals about interest rates. You look over at Japan and their bond yields are climbing, which tends to pull money out of stocks, and all of that together leads to the fourth point. Investors are selling their high-growth tech stocks and moving into more stable, value-oriented companies. It was a combination punch, really.
But you know, numbers and news headlines only tell you part of the story. To really get what happened today, we've got to look at the psychology of the market. There are some classic theories that can help us peek inside the collective mind of investors, and honestly, this is where things get fascinating.
Okay, so first up is a concept called systems stress. Think of it like this. Imagine you've been working flat out, pulling all-nighters for weeks on a huge project. You're exhausted, right? The slightest little thing can make you snap. Well, that's kind of what's been happening in the semiconductor sector. Companies like Samsung and SK Hynix have been under immense pressure to deliver the next big thing, these HBM4 chips. The whole system is just tired. It's fragile. So when even a little bit of bad news comes along, the reaction is huge. And that's pretty much what we saw happen with the KOSDAQ today.
And that leads right into our next idea, time preference. It sounds academic, but it's super simple. When people get scared, they want their money and they want it now. They're not thinking about 5 years down the road, they're thinking about tomorrow. They want safety. And we can actually see this playing out in real time. The yuan to dollar exchange rate shot up to 14.42. What does that tell you? It's investors dumping the yuan and running to the perceived safety of the US dollar, a classic flight to quality. So, the big question is, should we be panicking? Is this the beginning of the end? Well, not so fast. If you look at it through the lens of someone like Ken Fisher, this is what he'd call a classic zigzag correction. His research shows that in years with a US midterm election, like we have in 2026, you get these sharp, choppy moves. They're totally normal. The fact that the KOSPI only dropped a little bit, it actually fits this pattern perfectly. It might just be a healthy, short-term pullback in a market that's still fundamentally strong.
And one last psychological angle to consider is social mood. This is a bit of a chicken and egg idea. Does bad news make the market fall, or does a bad mood in the market just look for a piece of news to blame? This theory says it's the latter. The collective mood of investors was already getting a bit nervous in early February. The optimism was fading. So when that news about Microsoft's AI costs came out, it wasn't the cause of the drop, it was just the excuse, the trigger the market was already waiting for.
Okay, now let's shift our focus over to China and Hong Kong, because if you thought the drop in Korea was something, wait till you see these numbers. The fall was even steeper over there, and while the reasons are connected, they have their own unique local spin.
Yeah, just look at this. The numbers speak for themselves. The Shanghai Composite dropped over 1.25%, and the Hang Seng in Hong Kong? Down a painful 1.72%. When you see drops this much bigger, you know there's something else going on, some extra pressure specific to those markets. And here's the key difference. In Korea, the story was about intangible things, right? Like AI fatigue and investor sentiment. But in China, the problem is much more, well, physical. They are dealing with a property crisis that just keeps getting deeper. Throw in the usual nervousness that happens right before the big Lunar New Year holiday, and you can see why it was such a tough day. The government's been trying to pump money into the system, but it's like trying to fill a bucket with a hole in it. The weight of all that real estate debt is just too much right now.
Okay, so we've spent a good amount of time diagnosing what went wrong today. Now let's switch hats and move from diagnosis to prognosis. What comes next? Let's take a look at what our quantitative models are telling us for the rest of February. So, according to the models, we could actually see a pretty decent rebound by the end of the month. We're talking potential upside of just over 3% across the board for these major Asian indexes. But, and this is a really big but, you have to remember these are just projections. They are not guarantees. They're built on some key assumptions, namely that Korea's strong export numbers keep up and that China comes out with a big stimulus plan after their holiday. And the model doesn't see this as a V-shaped recovery where everything just snaps back tomorrow. It's projecting more of a three-step process. Step 1 was today, the big adjustment. Step 2 is next week, which should be about finding a floor, stabilizing, as the market really absorbs the positive news on Korean exports. Then Step 3 is the rebound in the last week of the month, and that's the part that really hinges on China stepping up with that post-holiday stimulus.
So, that's the potential roadmap. The question then becomes, how do you actually trade it? How do you navigate the next few weeks? Well, that's what this last section is all about. A disciplined, step-by-step quant strategy designed to do two things: keep your risk in check, while also putting you in a position to catch that potential upside.
It's a pretty straightforward four-step plan. We'll talk about how to time your entry point using volatility, then what kind of companies to focus on. We'll even look at a specific pair trade between Hong Kong and Korea. And finally, and most importantly, we'll wrap it all up in a framework of super strict risk management. So let's dig into that second step for a second, because it's really the core of the idea. The strategy is all about favoring companies whose value isn't tied up in factories and inventory. We're talking about intangible assets, their patents, their brand, their research. Think Samsung, think SK Hynix. On the flip side, the idea is to bet against the old-school industrial companies, the ones that are weighed down by a lot of physical stuff and, crucially, a lot of debt.
Okay, everyone, listen up. Because if you take away only one thing from this section, this is it. This is the most critical piece of the puzzle: protecting your capital. These aren't suggestions. They are hard and fast rules. If the KOSPI drops below its 50-day moving average, that's 5,291, you're out. No questions asked. And if things start looking really ugly and a strong downtrend forms, you put on a hedge. It's that simple. You follow the rules, no emotion involved.
So, let's pull back and look at the big picture here. What's the main takeaway from all of this? Well, it looks like today's drop, as sharp as it felt, was probably a healthy correction. It's a stress test for the market, for sure, but it doesn't look like a major structural break. The key fundamentals, especially those strong export numbers coming out of Korea, tell us that the foundation is still pretty solid.
And so, that really leaves us with the million-dollar question, doesn't it? Was today just a bit of thunder and lightning in an otherwise sunny bull market? Or are we seeing the first signs that the weather is about to change for good, a whole new season for investors? Hopefully, the ideas we've walked through today give you a better framework to come up with your own answer to that question. Thanks for tuning in.